Ind AS 113 fair value measurement. In various Ind AS, we need to measure the fair value for many assets and liabilities, etc. That fair value measurement will be done as per Ind AS 113. So Ind AS 113 guides how to measure the fair value. So scope of Ind AS 113 is this standard will cover all such requirements of another standards where fair value measurement is required. However, there are certain exceptions. The measurement of following fair values are not covered under Ind AS 113. First one, fair value, NRV. NRV measurement as per Ind AS 2 inventories is not covered under Ind AS 113. Second, fair value referred in Ind AS 116. Leases. So leases fair value measurement is not covered under Ind AS 113. Next, fair value, value in use referred in Ind AS 36. Impairment. That fair value measurement is not covered under Ind AS 113. Fair value referred in Ind AS 102, share-based payments. For measuring fair values of share-based payments, Ind AS 113 is not applicable. Respect to Ind AS will be applicable for measuring the fair values. Next, definition of fair value. What is meant by fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at a measurement date. What is meant by orderly transaction? Orderly transaction means which is not a forced transaction. Transaction done with full willingness. That is an orderly transaction. Fair value at initial recognition. Under that, first consider transaction price. Transaction price means it is the price paid to acquire the asset or receive to assume the liability. That is entry price. Fair value means fair value is the price that would be received to sell the asset or paid to transfer the liability. That is exit price. Therefore, fair value means exit price. But at initial recognition, generally, transaction price will be equal to fair value. If on initial recognition, another Ind AS requires an entity to measure an asset or liability at fair value, and the transaction price differs from fair value, existing example is a pre-existing relationship exists between the parties as discussed in Ind AS 109, or recognize the gain or loss in P&L unless that Ind AS specifies other treatment. So if transaction price and fair value are not the same, then recognize the difference as gain or loss in P&L unless other treatment is specified by Ind AS. Next, principal or most advantageous market. If a fair value measurement assumes that the transaction to sell the asset or transfer the liability takes place at either principal market or, in the absence of principal market, most advantageous market. Principal market. Principal market means market where the asset or liability is being transacted with highest volume or highest activity level. For example, Reliance Industries Limited share price in BSE is 349, in NSE is 350. Highest volume is in BSE. Hence, fair value will be the price in BSE, that is 349. Next, in the absence of principal market, most advantageous market. Most advantageous market means market which maximizes amount received on selling an asset or minimize amount paid while transferring the liability. That is market which gives the best price. For finding most advantageous market, we need to consider both transportation cost and transaction cost. So both costs need to be deducted for finding most advantageous market. How to calculate fair value? Fair value will be market price less transportation cost. Here, transaction cost is ignored because it is dealt in respect of Ind AS where fair value will be used. Because it will be dealt in respect to Ind AS where fair value will be used. So while calculating most advantageous market, fair value formula will be market price less transportation cost less transaction cost. How to calculate exact fair value? That equals to market price less transportation cost. Fair value rules for non-financial asset. First, identify the highest and best use of non-financial asset for market participants. Analysis of highest and best use. The highest and best use should be physically possible, legally permissible, and financially feasible. Entity-specific restrictions would not be considered while finding out fair value of non-financial asset. In the absence of potential best use, which is not easily available, its current use would be considered as best use. Next, fair value rules for liabilities and entities own equity instrument. Fair value of liability or own equity instrument would be quoted price in an active market if available. If direct quoted price in an active market is not available, then use quoted price of identical or similar liabilities or equity instruments which are held by other market participants as an asset. In the absence of above, use valuation technique such as income approach, market approach, etc. Valuation techniques are discussed in below point. Fair value hierarchy. There are three levels of inputs for calculating the fair value. Level 1 inputs, quoted price, that is unadjusted in active markets for identical assets or liabilities that the entity can access at the measurement date are available, then it will be the fair value. A quoted price in an active market provides the most reliable evidence of fair value and shall be used without adjustment to measure fair value whenever available. So, in case of a level 1 inputs, quoted price will be the fair value. Level 2 inputs, inputs other than quoted price, including included within level 1 that are observable for an asset or liability either directly or indirectly. Level 2 inputs includes quoted price for similar assets or liabilities in active markets, quoted price for identical or similar assets or liabilities in markets that are not active. Level 2 inputs can be adjusted, but these adjustments should not be significant. If it is a significant adjustment, it will be categorized into level 3 automatically. So level 2 inputs means quoted prices of similar assets or liabilities in active markets or quoted prices for identical or similar assets or liabilities in a market that are not active. Next, level 3 inputs. Level 3 inputs are unobservable inputs for an asset or liability. It might include entities' own data such as financial forecast, historical volatility, etc. For fair valuation, maximum weight should be given to level 1 inputs and lower weights should be given to level 3 inputs. Next, is quoted price for an identical item in an active market is available? Answer is yes. Is the price to be adjusted? No. Then it will be level 1 input. Is the price to be adjusted? Yes. The price needs to be adjusted. Are there any significant unobservable inputs? Answer is yes. Then it will be level 3 input. If it is no, it will be level 2 inputs. If quoted price for an identical item in an active market is not available, and are there any significant unobservable inputs, it will be level 3 input. If there is no significant unobservable inputs, then it will be level 2 inputs. Next, valuation techniques. There are three valuation techniques. First one, market approach. The market approach uses prices and other relevant information generated by the market transactions involving identical or comparable. Comparable means similar assets or liabilities. Example, valuation techniques using market multiples derived from a set of comparables. Second, income approach. The income approach converts future amounts, example, cash flows or income and expenses, to a single current amount, that is discounted amount. The fair value measurement reflects current market expectations about those future amounts. Example, discounted cash flow method, discounted dividend discount model method. DDM. DDM comes under income approach. Next, cost approach. It is a valuation technique that reflects the amount that would be required to currently replace the service capacity of an asset adjusted for obsolescence, often referred to as replacement cost. Example, this method may be used to measure non-financial assets. In case of availability of quoted price, which are being used in an active market, there is no need to consider any valuation approach. Generally, valuation approach is used. Valuation approach is used if direct quoted price in an active market is not available, or quoted price of identical or similar liabilities or equity instruments are not available. In such a case, valuation techniques will be used. So there are three valuation techniques: market approach technique, income approach technique, cost approach technique.